Alright, welcome back everyone. So today I'm going to be talking about Deliveroo. It's a company that IPO'd a couple of weeks ago. We'll be discussing some of the potential issues with the company, but equally we're going to be looking at some of the positives going forwards. So first up, let's understand what Deliveroo is and how their business model works. Now, for those unaware, Deliveroo is an online food delivery company that were founded back in 2013 in London. Now, they have a global presence and they enable customers to place orders through their app or website, and then your food will be delivered by someone, generally speaking on a bike, but equally a motorcycle, where they transport the order from the restaurant to the customer that ordered the food. Now, a few years back in 2017, Deliveroo created Deliveroo Plus, which is a subscription service and enables customers to have unlimited free delivery in the UK. And so Deliveroo is positioning themselves to act as the food transportation mechanism. Now, the business model of Deliveroo works well in some countries where you don't have these independent restaurants that aren't running their own delivery system. Given that traditionally in the likes of the UK, you would have restaurants that wouldn't even consider delivering their food. They would want their customers to eat within the restaurants. But other countries out there, let's just say you have 1,000 different restaurants which all have their own transportation system to deliver the food to the client, then you're going to have that competitive nature given the customers have the freedom to order from different companies. And so the cost in terms of transportation fees is less likely to be passed onto the customer. Now, that's different from Deliveroo. The company is trying to have a monopoly across all the different restaurants, and when you have a monopoly, then you can either pass on the smallest amount of cost to the customer when delivering the food, given that on every order you make a micro transaction which has the net effect of really affecting the profit margins. But equally, if there is no competition out there, then you can charge a standard fee. And there's very little anyone can do given there's no other alternatives when getting the food delivered to your home. Now, there was a lot of news out there in terms of the IPO. I mentioned in previous videos that I generally stay away from buying into companies that immediately IPO. A good time to wait is generally 3 to 6 months just to see how the company is performing. Now, that can backfire. There's certain companies out there, let's take Zoom for example, which has just increased non-stop pretty much since they IPO'd, but there was definitely an expectation for Deliveroo to be at a value much higher than what it is currently. And prior to the public listing on the London Stock Exchange, retail investors were able to buy Deliveroo, and it was expected that once the public listing is available, then the price would increase, but a lot of those retail investors ended up buying around the £3 to £4 mark and have since seen paper losses of around 30%. Now, with all the negative news out there, I actually want to focus on some of the positives with Deliveroo listing on the London Stock Exchange. Now, there's other gig economy equivalents that are listed on US stock exchanges, and Deliveroo could have followed a similar path as well. But for UK investors especially, it's one of the first times we've seen a tech-based company that's in this gig economy space that's been listed on the London Stock Exchange. And given that the price has decreased by around the 30%, for me it's just an opportunity to buy into the company. And that's what I've done. You can see on the screen here, I have a small position, just 35 shares. I'll be adding to my position in the future. But let's try and make sense of why this company hasn't performed as well as it was expected. And I'll be talking about whether they are a real concern or not. And so first up, there's been pressure for gig economy companies to not have independent contractors. We've seen this with the likes of Uber with their drivers, and there's been rulings put in place so that the drivers of Uber, for instance, are now members of the actual company. And so while this gives better protection for the driver, there's still this debate on what it means to be within the gig economy. Now, taking politics aside for a second, I actually think that the gig economy made more sense how it was in the past. So if I want to drive for Uber, or if I want to take on some delivery-based jobs, once I have that transportation, whether it's a car that I own or a bike, then at any moment of time I can stop working and I can be a true contractor in that sense. Now, it's definitely debatable, and we've seen with the likes of Uber that drivers are now becoming a part of the company. Now, as for the company, the concerns here is that there will be increases in minimum wage. Given that they won't be contractors anymore but more of a full-time employee, then drivers or Deliveroo cyclists will have the similar level of sick days and paid time off. And the concern with Deliveroo is that revenue is going to decrease just because there'll be added costs to hit that minimum wage for their cyclists. So is this a big concern? For sure, revenue forecasts are going to change should there be new laws with respect to the gig economy, but this is going to impact all the other competition that's out there. Companies are very quick to adapt, so whether there's more cost to that of the restaurants or whether the cost is pushed onto that of the consumer, that is just speculation at the moment. But there's ways around in the event that Deliveroo has a bigger workforce due to moving all their contractors to full-time employees. Now, the other concern with the listing of Deliveroo on the London Stock Exchange is that the voting rights that you have when you buy into ticker symbol ROO is not the same as some of the bigger shareholders in the company. And so this is known as a dual class share structure. It's actually existed in the US for over a decade. A common example is that of Google, which has their Class A and Class C shares. And so it's assumed that given that there's less voting rights when you have a dual class share structure, then it's going to put off the retail investors. But I couldn't imagine this being a massive effect. For instance, if I buy Class A shares of Google, then even though I own these Class A shares, and I've done a separate video on this in the past, but I'm not the one who owns the underlying shares. It's Trading 212 that has all the voting rights, given that they hold all the stock for everyone on the platform. And so whether or not we have the option to buy into the Class A or the Class C shares for Deliveroo, it wouldn't make much of a difference anyway, given that we can't actually vote. We're not invited to the board meetings. And historically, when you have a dual class share structure, there's times when even the stock that has less voting right becomes more expensive than the one that does have the voting right. And so the point here is that both shares can increase over time. So out of the 2 points raised, this issue is not one that I think is even taking place. People that want to hold Deliveroo stock will simply buy it, given that it's listed on the stock exchange. Now, in terms of the company, they're a growth-based one and they are not profitable. We can see for 2020 that their net income was negative 226 million. There are concerns on how the business model operates. So you've got the connection with the restaurants, which are charging from 30 to 40% per order. There's many restaurants out there that are unhappy with such high numbers. But even with that high fee structure, Deliveroo has reported this net loss. What'll be interesting to see is this subscription model that only exists in the UK. And so whether or not they can use this subscription service to generate more income, that is yet to be seen, but there's potential there. Now, these days with growth-based companies, whether the company is performing well or not is separate to the underlying stock price. So we've already seen a 30% drop. We do have the potential to see this stock pushed to even higher numbers. We've seen it time and time again with these low-cost shares. So at £2.82, we can easily see this stock pushing to even higher numbers, even when the number isn't backed by any fundamentals. But the one thing to point out is that when the stock was first listed on their IPO at £3.60, this was at the lower estimate of what the company is expected to be worth in the future. And if you look at other examples out there, Facebook in the past, when it was first listed on the US stock exchange back in 2012, at the end of their first year, they were down 50%. So there are just some companies out there that just get hit badly when they IPO. So it's going to be exciting to see where Deliveroo ends up in the future. It's great to see this listed on the London Stock Exchange. And what's even more exciting is all the other tech-based companies that may enter on the London Stock Exchange in the future. I don't see the reduction of the 30% during the first week of Deliveroo as a deterrent for other companies out there. That's definitely been how it's been broadcasted. But I think we have to share the excitement that we have a tech-based company that is finally on the London Stock Exchange. And that can only give rise to other great companies in the future that we'll be able to invest in. And for anyone that has their Trading 212 account in pounds, then with all the changes taking place on Trading 212 with their FX fees, we won't be hit by those given that it's a UK-based company. You'll have the standard stamp duty when you're buying into these shares, but that's slightly cheaper than if you are to buy and then subsequently sell for any growth-based company listed on the London Stock Exchange. So let me know in the comments below if you're interested in buying Deliveroo. Do you think the price reflects how the company is going to be performing in the future? Or do you just think that it was bad timing when they listed on the IPO? So let me know in the comments below what you think. New videos are out each week. And with that said, I'll catch you in the next one.